we should be able to, yeah, we're getting a message that your feed is being recorded. Okay. All right. Okay, so let's go on to where we finished the other day. So we talked briefly about the point. We're on page 20. Obviously, we're proceeding slowly, but there are many things to be done. In fact, I will hold at least one more session with you on the project brief to give you some kind of idea, because the project is quite important for your learning. So I'll give you a little bit more structure, and I'll do that later in one of the later sessions. So we're proceeding slowly as far as the book per se is concerned, but you know what the reason is, that we have certain things to cover, certain ideas to cover. Okay, so the idea here, you can see here the difference between defensive and enterprising, which we started with. And we talked about the connection here. What he's talking about really is he also used the words himself, passive and active. But from the time that he was writing about it, the difference, these two terms have become much more widely used, passive and active. So they're more widely used. So we talked about this, and I've given you, so you have to understand that as an active investor, you basically don't, if you're a passive investor, you believe in this semi-strong form market efficiency. Then, but if you're an active investor, you don't. Okay, so you don't believe the market is semi-strong form efficient. And that's why you keep trying to pick stocks, stock selection, etc. So stock picking. So these people are actually known as stock pickers. So what you can do here is, I've given you a link. You can read this. Then he's talked about mixing the two approaches here. But you can just read this article for your information. All right. So now here on page 21, you see that. So the idea, most of the people that are running funds. Are running actually most of the mutual funds that you hear about. These are all actively managed mutual funds, like your HDFC 200, etc. So generally, the passive funds or the defensive funds, let's just call them passive funds. The passive funds just tend to be in the form of ETFs. ETF, like a bank Nifty or something like that, where if you have an ETF on the bank Nifty index, it means it will just invest in the banks in the Nifty index. So it's not going to make any. So it will probably just use the market value, market cap weighted mix of in terms of the quantum of stocks in the portfolio. So it will be very passive, and it will not try to make a specific judgment about whether SBI is going to outperform Axis Bank or anything like that. So those are generally in the form of ETFs. So passive investing generally tends to go into ETFs and over a broader index funds. Okay, so either you have broader index funds, and let's call this passive versus active investing. So this is connected to this idea of you should understand that. Put this here actually. So in passive versus active investing. Okay, so let's do it this way here. Okay, so passive investing, basically, I'm just developing this idea a little bit further. So these are important ideas. You need to understand it more completely. And active investing, right? Passive investing typically is either index funds, or this is the classical approach to passive investing, in the sense that you invest in the entire fund. So I'll just give you some examples. We take, let's try to give you some examples looking at charts. Okay, so again, we use US markets as examples because the market is more developed. We have many more examples or many more different types of ETFs to choose from. The ETF space is also pretty big in the US market. So if you look at the most popular index fund would be the SPY. So this is the ETF. Okay, it's the Spiders Trust. It's the name of the SPY. This tracks the S&P 500 index and is listed on the NYSE. So if you look at this, that's your Spiders. This is the ETF for the S&P 500. So if you're a passive investor looking at US markets, this is a very broad index. It's got 500 stocks. course, you can pick even broader indices like the Russell 2000, etc. But these are the large cap stocks. So if you're interested in investing in the large cap US equity space, then you go for something like this, and you are a believer in passive investing. So you just go for index funds. Okay, so the index funds are which are very often in the form of ETFs, right? So if you go to any of the big sites, you will find go to Yahoo Finance or somewhere, you will find that there is an ETF. There's a big section on ETFs in most of it because there are a lot of ETFs now. So you'll find a lot of ETFs. Look at yeah. So if you look at, let's take this. Let's take this thing here and show you. There are a lot of ETFs. So this is an example of an ETF. The SPY is an ETF. ETF is just, as you know, it's an exchange traded fund. So it's just a kind of a standardized kind of a fund. Okay, so this ETF, you know, is always going to track the S&P 500 index. So usually the ETFs track some index or the other. So if you go and look at this, you go to markets, you will find that there is a list, there is a section for top ETFs. So if you go to top ETFs, you'll see what are the top ETFs. Okay. There must have been some kind of okay, so you can apply different screeners, but these are some of the top. This is the ETF that tracks the Nasdaq 100. Okay. So there are many ETFs, and then you have sectoral ETFs also. Actually, if you look at sectoral ETFs, if you look at this, for instance, how do I look at, say, XLM? Okay. XLM is there should be, or maybe let's look at XLF. Okay, so if you look at XLF, this is the Financial Select Sector Spider Fund. These are also ETFs. This is also an ETF. So you can see XLF. This is like kind of like a Bank Nifty, but a little bit broader because Bank Nifty is only banks, and this is all financial companies. So if you go, this is the very famous, very well actively traded ETF, XLF. This tracks the US financial sector. And if you go to holdings here, you can see that these are the holdings. Top 10, they also give you the top 10. You see that most of it is in 100% is in financial services. The sector weightings, if you see, it is nothing in basic materials, nothing cyclical, nothing real estate. Okay, it's 100% in financial services. And if you look at the top 10 holdings of this ETF, so it's a useful trick you can do for ETFs here on Yahoo Finance. They'll give you the top 10 holdings, and you can see what the top 10 holdings are for this XLF ETF. So generally, they will try to go for a market cap weighted kind of split. So you can see these are all financial companies. So this is an example of. So you could also call this passive investing if you just invest in the financial sector, but a little bit less passive than going for this. So index funds, either index funds or sector funds. Okay, so sector funds is a little bit less passive than index funds, because index funds means you're going for a broad index. So S&P 500 includes all the 500 top US companies. So it's not just confined to financials. But if you go for XLF, it's very concentrated, as you can see, in financial services. So you're making a conscious, to the extent that you invest in this, you're making a conscious sector bet that this will outperform the other sectors. I mean, assuming you put all your money into XLF, that means all these other sectors you're ignoring. So in that sense, it's a little bit less, or you could say quite significantly less passive than investing in an index fund like the S&P 500 broad index ETF. But it is still can be considered a part of the passive investing, because you're not making any active stock selection here. Like for instance, if you look at the top 10 holdings within XLF, even within the banks, you could have decided there is some kind of mechanical formula. The main idea between this of the sector ETFs and ETFs in general is that there is some kind of predetermined formula which determines the weightage of the stocks in the portfolio. Like this, Berkshire is 13%, JP Morgan is 12%. You can see basically this is obviously there's some kind of market value weighted element there, because these are much smaller companies than JP Morgan is much bigger than Schwab or BlackRock, etc. So therefore there's some kind of market cap. So there's some kind of mechanical formula which goes into the selection of the stocks in the ETF, the weightage of stocks. This is the part we're interested in. The weightage of the different stocks, the top 10 holdings, what is their weightage, okay, in the portfolio. Now this is typically in a case of an ETF, it's done in a mechanical way. So, but you could have a broader ETF, or you can actually put a bracket there. And then both of these can be tracked through ETFs. Either you can have an index fund being tracked by an ETF, or you can have a sector fund, which is, or both are as in the form of ETFs. Okay, so the idea behind the ETF is that there is some kind of mechanical formula, whereas in the case of active investing, so that's passive investing. So you try to just focus on the index, and you believe in the semi-strong form efficiency. So you believe that there's not much I can do by I cannot outperform the broad stock market index, or even a sector index. So let me just passively put my money in an ETF which is going to track the index, either a broad index or the sectoral index. So that's the idea behind passive investing. And in active investing, of course, you do what is called stock selection. Okay, so this is actually called stock picking. Stock picking or stock selection. Sometimes you call stock picking is better actually. Stock picking is a term that is used. So most of the big hedge funds that you see, even a big fund like Citadel, a lot of their money is managed by doing plain old-fashioned stock picking, which is basically nothing but using basically saying that we don't believe that the market is semi-strong form efficient. So there's some value to doing some fundamental analysis. So they will actually they will go through the financial statements. They will do the kind of work that I've given you to do in the project, which is they will analyze the security. They'll look at different. They look at the different securities, decide that one is better than the other, and so that's basically what we call stock picking. So picking individual stocks. Okay, you can just keep it as stock picking or stock selection. So actively stock picking. So basically, the implication is that let's say the relative weights of stock. This is the important thing. How do you understand that a particular portfolio? If I give you any particular index, if I give you any particular fund portfolio, because an ETF is also a fund. Okay, it's a passively managed fund, but it's a fund. So anywhere you're actually commingling a lot of money and buying securities. So if you're taking money from different investors and investing in securities, or ETFs can also be treated as securities. If you're taking money from multiple investors, that's a fund. That becomes a fund. Okay. So ETFs are also funds. Now, so whether it's a passive fund or an active fund, how would you really know this, other than the fact that they might say so in the name? But the other way to know it is that the telltale way to know it is that the relative weights of stocks in an active portfolio is likely to be very different from the relative relative weights of stocks in an index. Okay, this is the basic test. How would you know? Again, if you're talking, always try to go for highly specific definitions. So the definition of an active fund, how would you understand an active fund? Typically, when you look at, if you're allowed to look inside, you assume that you're allowed to look inside, like we're looking over here inside the XLF. We're allowed to look in here because XLF is an ETF, and the formula for their selection is quite. So even for other mutual funds, you would have this because they have to declare their holdings, etc. So you can see this in the ETF. You can see that if you look at the financial sector index construction, you will see that the index construction also has approximately this kind of weightage for these stocks. That's why the ETF is also going for this kind of weightage. If you go for something else, if we have any other, if you look at the S&P 500, okay, if you look at SPY. Now, here, if you look at the whole, now this is an ETF, so this is a fund, so you will get this option of holdings. Now, this option of holdings will not appear if your ticker is, in this case, we search for SPY. That's our ticker. There's no other ticker. If your ticker is, say, IBM or Microsoft, then you will not get this holdings option. Okay? This you get only when your ticker is actually for a fund or an ETF or actively managed fund or an ETF. So that's the only time that you get the holdings option. But let's look at the S&P 500 index, the holdings. Yeah, there we are on holdings. Overall portfolio, stocks, very little and hardly anything in bonds. Okay, look at this. Now you see sector weightings. You can see these are broadly matching the sector weightings within the S&P 500. So this has to track. The point of this ETF is when you make an ETF, you make a declaration to the public that my ETF will track either the Bank Nifty index, or it'll track the Nifty 50, or it'll track the Sensex, or it'll track the S&P 500. You make a declaration. That's how people get to know what the ETF is about. So you make a declaration to the public. So you have an obligation to ensure that the performance of your ETF tracks the performance of the underlying index, which in this case is the S&P 500. So these guys, that's why they are mechanically structured, because they have to track the performance of the S&P 500 index. So the way they do this, how did they arrive at this kind of portfolio composition, which is a kind of a second level disaggregation or first level disaggregation of the fund? You look at the whole fund, you disaggregate it into the sector weightings first. You look at where the sector weightings are, and that kind of tells you what are the big sectors in the US economy. As you can see, the biggest sector in the US economy, clearly in terms of market cap, is, what is it? What is the biggest sector? Can anyone tell me? In terms of most dominant sector, in terms of market cap, what are we looking at in the S&P 500? Anybody? Whatever. Question is not clear. What is the most dominant index in the S&P 500? What is the most dominant sector in the S&P 500 in terms of the
technology?
Yeah, so technology is the most dominant sector. So if you want to get an idea about the US stock market, one way, what is the composition of the of weightage of relative companies and relative weightage of sectors? Okay, this also gives you certain ideas, because remember, these ideas can be applied to any economy. You can apply this to the Indian economy also. You may not get this information easily, but you'll be able to. The concepts remain the same. Okay, so there's some background noise. Just ignore it. The concept remains the same. Okay, so any economy that you look at, you can apply these kind of basic sectors, split it up into these basic sectors. That's why it's important to study the US, because you get to see what a developed economy looks like. You can go to Japan also and do the same thing in Japan. So you can see this now. So this basically reflects the weightages in the S&P 500 index. And then again, this one also, top 10 holdings, if you see, these are the top 2 holdings. So these are all trillion-dollar companies. So they have to hold these companies. You can see how big they are in terms of the overall fund, given that it has 500 stocks. So you can see the top 10 holdings. Why is Apple 6%? Because if you look at the structure of the S&P 500 index, you will find that Apple is around 6, is 5.9%. That's why these guys actually also have to hold this proportion of Apple. Otherwise, they'll be in violation of their commitment to the public when they launch the ETF. Okay, so this is the thing, that when you look at an ETF, it is basically going to, because an ETF is passive investing. Okay, so therefore, when you look at the composition of an ETF, then you will find that the split, the relative weights of stocks matches the relative weights of stocks in the index that it's supposed to track. But when you look at an active portfolio, which we're not, you can always look at something. You can look at a Fidelity Magellan fund, which is one of the most famous funds. Yeah, so Fidelity Magellan fund, if you look at. Now they also have an ETF to track the Fidelity Magellan fund. This is obviously, so there's another book that I would recommend for you. I should put it in the Q&A. I think I put it in the Q&A or somewhere. Oh no, I put it in somewhere here actually. Okay, so if you go back, Peter Lynch. So the most, yeah, so One Up on Wall Street is another book where you can find this actually on YouTube. You can find the audio book of this also for free. And you can, I think you can search on the internet, you can get the book PDF also. So this is also another book that should actually go into your the list of books in the project resources. Okay, I haven't had time to put it up there, but you can put it up there. I mean, mentally you can put it up there. This is another very important book to read for stock investing. So Peter Lynch is actually he has one of the best trading records available, of all time as a mutual fund manager. You'll find that mentioned in this book also. So Peter Lynch, this is the book that he wrote. He managed the Fidelity Magellan fund. So he has a fantastic track record. Now, if you look at the Fidelity Magellan fund and how it's performing, you can again look at the holdings, and you will find that the holdings, okay, the sector weightings, you will find, now look at that, the S&P 500 sector weighting for technology was 24%. And so that means the index has 24%. But if you see these guys, they have overweighted technology. You can see the fund, when you look at a fund, you can just go into the top sector, just at the sector level, without even going down into the individual stocks. You can see that 35% in technology, it's overweighted in technology relative to the index weight, which should be about 24%. So this is how you find out what kind of bias a fund is carrying. But this is proving my definition. Okay. So what is the definition? So this is how you know that this is an actively managed fund. Because just look at technology as one example. The sector weight for technology is 35%, whereas the S&P 500 index sector weight for technology is 24%. So this is the definition. That's why I gave the definition like this. Yeah, what is the definition? That, how do you understand that this something is an active fund? Remember, all definitions have to be as far as possible like a computer definition, which a computer can understand, highly specific, no loose statements. The relative weights of stocks in an active portfolio is likely to be very different from the relative weights of stocks in an index. Okay, and when I say stocks, this includes sectors also, because a sector is just an aggregation of stocks. Okay, so you understand this point. So this is how you understand that a fund is an active fund. So why is this guy doing this? Because he feels that he does not believe in this. He does not believe the market is a strong form of vision. So based on the analysis that he's done, he believes that technology will outperform the rest of the sectors, at least some of the sectors. So he's put more money into technology than the index tracking ETF has, right? So he's made a bet on technology. So if it doesn't work out, then he'll lose money. So, and he'll not be able to, because he's going to be benchmarked against the S&P 500 index. So he will his performance will be poor relative to that index if his bet does not work out. Okay, but that's what you do in active investing. You make specific bets based on stock picking, that and basically that leads to different weightages for stocks than what you would see in an index. So this is the idea of, and this. Okay, so this is the important idea if you need it to be developed, because it's important to understand this. Okay, so he's talking about selecting the sectors, so industries, etc. Or you can say industry is a lower level. This is not cast in stone, but sometimes people say the sector is a broader idea. Then within, say, technology as a sector, you could have maybe chip manufacturing as an industry. So it's a little smaller than the idea of a sector. But these are not hard and fast definitions. So it's important to clarify exactly what you mean by sector, what you mean by industry when you're conducting a discussion. So you should do that. So yeah, so here he's just given these two parts, what he's talked about here in these 2 pages, that a lot of people try to go to identify sectors or industries that are likely to outperform, okay, which many people have done in the case of tech also right now. So so he's given 2 examples. One is computers, technology, I guess, computer industry, and then he's given the example of the air traffic industry. So they may feel that the air traffic sector is going to grow, and so they invest in stocks in this. So, but the example that he gives later on is that unfortunately what happens, and you have seen this in India also, that you can see it to some extent in telecom as well. All the stocks have not done well. Some are actually in big trouble, like Idea and all these people. So, and of course, we had the Anil Ambani, Reliance Communications also went under. So and then in airlines also, you find most of the airlines are not doing very well financially. Kingfisher, of course, blew up, and so all kinds of problems. Jet Airways, all kinds of problems. Although airline traffic has been growing, so this is the point that he's trying to make, that the sector might grow, but because individual stocks may not be, individual companies may not be. See here in the US also, there is a new high in traffic figures, but the airlines are sustaining a loss. Okay, so because that's, I guess, because of competition in the industry. So there's too much competition and there's too much price cutting, etc. And they can't raise. So the traffic figures are growing maybe because prices are at a certain level, and if you raise those prices, then you may not get the volume. People will take other routes, like in the US, where the road network is quite well developed. So people are actively always deciding, or they look at the, I mean, of course, if they're traveling from New York to LA, they have to generally fly if they care about time. But for shorter distances, people will always evaluate whether it's cheaper to just drive rather than to fly. So these guys have to keep their, because they're looking at substitutes. So the airlines have to keep the prices low. So one of the reasons this might happen is obviously the highly competitive nature of the industry. So lack of pricing power. So therefore, although the industry, volume figures are growing, but you don't find any profitable stocks. Okay, so that's what he's talking about. So here he's given this example, 2 examples here. One is given with respect to airlines, and one with respect to computers. So airlines, obviously, generally, most of the stocks have done badly that in this period. And in the case of tech or computer industry, what happened, what he's talking about is that IBM did very well, but the other stocks did not do very well. Okay? So here, this brings us to another idea. Okay? And he's given these 2 lessons that just because the business or sector or industry is growing does not mean that the particular stocks of companies which are operating in that sector will necessarily do well, because the industry, the sector may not be profitable for the companies. So traffic is growing, volumes are growing, but the individual companies are not making profits. So now you can see here, and then this is the other one, which is the experts do not have dependable ways of selecting and concentrating on the most promising companies in the most promising industries. So generally, attacking the idea of relying on experts, which is always a good thing. I mean, it's always good to trust your own common sense than more than the experts, than the expertise of experts, so-called experts, because as we can see here in this pandemic also, there is these so-called experts are actually not able to come up with good ideas. So more and more, everything that you see in the world around you is pushing you more and more towards relying on your own common sense, which in many ways will lead you to better decisions than relying on experts. Because experts may have all kinds of issues. Actually, they may have conflicts of interest. They may have ethical problems, and they just may not have done the work, and they might have just become lazy. So and so it's always better to rely on your own common sense. Always trust your own common sense more than an expert. So because at the end of the day, you have to look out for yourself, and the experts will not save you. No, one second. This is not correct. Let me just. There's lots of pain for everyone. So this healthy skepticism for experts is a very good idea. Actually, I think we should really, because all of us have a tendency to rely on experts. But what I would tell you, this is more of a personal message from me, okay? Because anyway, I will not have much more time with you all. The general personal message for me, not just in investing, but in every area of life, even in the pandemic, how to manage. Don't rely on experts at the expense of your common sense. If an expert is saying something which does not make sense to you, just disregard the expert, because most of these guys really don't know anything. Okay, uh, and they're okay, just hold on a second, okay? Yeah, sorry about that. I had to receive an important courier. Actually, I could not afford to miss it. Okay. Um, all right. So where are we here? We just need to uh, magnify it again. Okay, there we are in this. This is what we have just finished. Okay, and I was telling you about this important aspect of not trusting experts, right? And trusting your own common sense. I'm seeing too many events that are happening, which are very important in our lives, and the experts are letting us down in terms of what they're offering. Okay, so let's look at page 21. Those are general life lessons beyond this, what he's talking about in the investing context. Investing also, don't trust the experts. Form your own opinion. That's always very important. Okay, now let's go back to the book. Yeah, now what he's talked about here. Let's see what he's saying. That's a different topic. Okay, here. Now, what is he talking about here? In the case of the IBM example and the tech industry, what happened with IBM? What he's saying is, IBM outperformed the rest of the tech industry, but because the investment funds had certain kinds of problems in terms of the way they make decisions, they needed to be very certain, etc. I mean, I guess what he's saying here is that they're kind of risk averse, and this prevented them from having more than, say, 3% of their funds in the wonderful performer. Now, this is the problem that he's talking about here, is that although many of these investment funds had put money into IBM, they did not have a disproportionate amount of money in IBM. Okay? They did not make a concentrated bet on IBM. Okay? So if you see here, earlier also he has talked about this idea of concentrated bets. He's talked about the word concentration earlier also. Okay, you can find it in the book in just one previous page. He's talked about concentration. So I'm coming to that important idea. So what Graham is talking about is that this phenomenon is that these guys generally tend to follow the if they're managing a tech fund, they would typically tend to do what they would tend to do is, because in tech you can look at the you would look at the QQQ, which is managed by Invesco, as an asset management company. This is the NASDAQ 100 index. Okay, this is the ETF that tracks the NASDAQ 100 index. So that would be typically a benchmark for a tech fund. If I'm managing a tech fund, I'm likely to be benchmarked against either the NASDAQ 100 index or the NASDAQ composite index. What you see here, this is the NASDAQ composite index, and then this is the NASDAQ 100 index. So this ETF, this tracks, just like SPY tracks the S&P 500, this tracks the NASDAQ 100 index. Now look at this. Again, if you look at this holdings here on this ETF, this is an index tracking ETF, okay? A sector index tracking ETF, kind of similar in idea concept to the Bank Nifty. So it's just like you have a Bank Nifty focusing on bank stocks in the Nifty. Similarly, you have or similar in idea to the XLF. Here you have the QQQ, which is focused on tech stocks. You see certain types of concentration in consumer cyclical, but mainly you can see 45% is in tech stocks. Okay, and of course some of it is communications. That's considered to be, they get included in the index because AT&T and Verizon and companies like that. So you can see here that again the top 10 holdings. Now what was I talking about? Yeah, okay. Now if you look at this fund, or what would the example that he's talking about here is that some of these fund managers did invest in IBM, but IBM outperformed the rest of the stocks in the tech sector by a significant amount. But what Graham is saying is that most of the fund managers could not make much money in IBM because they did not have the guts to make a concentrated bet on IBM and say that IBM is going to do better than the rest of the stocks in the tech sector. So they kind of played it safe, and they would have done what is known as index tracking. Okay, so sometimes they use the word index tracking or closet indexing. That would be a better term. I'm going to write it down. But what they did is basically they looked at, I'm just talking about an example here, that what they would have done is, of course, in today's tech world, IBM is not really a big player because it's kind of gotten a little confused on strategy and all that. So you can see the top 10 holdings in the QQQ. IBM is not there, although this focuses on NASDAQ stocks. So anyway, so you can see here this. So what these guys would have done is they would have taken an approach like this. The tech fund managers, they would have said, okay, Apple is gets in my benchmark because this QQQ is the benchmark. Okay, this is tracking the S&P NASDAQ 100 index. So this is going to be my benchmark if I manage a tech fund. So they would look at the weightage of Apple in the benchmark, and they would have said, okay, Apple is 11% in the benchmark. Now, if I put like 30% of my money in Apple, and what if Apple doesn't outperform relative to the others? No, I don't want to take such a strong view on Apple. Let me stay very close to what the benchmark requires. Okay, so so basically they would have been playing it safe and not and would have distributed that money in roughly in proportion to what the index or the benchmark has. And therefore, this is the problem that he's talking about here. That these guys kind of played it safe and did not make a concentrated bet on IBM, which happened to outperform. So this kind of behavior is known as, So perils of diversification is not enough money. There are two observations here. One is we put this as a second observation, and the other term that you need to know here is okay. So now here, so this is known as, this is a term that you need to know. This is called closet indexing. So closet is basically, you have this expression that, coming out of the closet and all that kind of thing. So this is based on that kind of terminology. So we call this closet indexing. Is a phenomenon where active managers in fact tend to closely mimic the weightage of stocks in the benchmark index portfolio. Okay, so although they're active managers, so they're supposed to be taking specific active calls on stocks. So if an active tech manager is looking at the index, the QQQ, which is tracking the NASDAQ 100 index, and he sees this kind of split, Apple is 11%. His job is actually to take a call and say that, well, Amazon is not going to do so well, but Microsoft is going to do very well. Nvidia is going to do very well. Maybe Tesla will not do so well. So his job is actually to put, Nvidia is 365, 3.6, about 4%. He was supposed to put like something like 15-20% in Nvidia, then put about, say, Microsoft is around 10%. He should put maybe 25% in Microsoft, and put less than the benchmark in Amazon. He thinks is not going to do well, so he should maybe put only 5% or 4% in Amazon. And this kind of decision making has to be done by an active manager. That's the whole point of being an active manager, that you make specific calls. Remember, this is called stock picking. This is called stock picking, right? So you have to pick stocks, and therefore by picking stocks, you're also rejecting the ones that you're not picking. So this is what is expected in active investing, and that's why the fees on active funds are higher. Okay, because I should write down here. Hence, management fees on active are higher. So relatively higher than the index funds, because in index funds actually there is so in index funds obviously it's passive investing in ETFs, and as I told you, this is the formula. How do I decide how much this ETF should hold, how much Apple, how much Microsoft, etc.? Well, we just look at the structure of the construction of the NASDAQ 100 index, which this ETF is supposed to track, And the index construction obviously has a formula to it. And in that formula, we see that currently Apple is 11%. So my decision is quite easy. Then I am also going to hold 11% Apple, 9%, 10% Microsoft, and so on and so forth. So not much work involved. Kind of you can automate most of it. Not much work involved. That's why passive funds, less management fees. So management fees on active funds, another important distinction. Typically, management fees on active funds are relatively higher. When I say relatively higher, what I mean is that it is higher than the passive funds. Okay, so the management fees on active funds are relatively higher. Now, the problem that Graham is referring to when he's discussing the IBM example, what he is talking about is there's a phenomenon that you should be aware of. This is called closet indexing. Closet indexing means you're inside the closet, right? So like they say for, maybe for gay people, they might say that this person is gay, but he's inside the closet, so nobody knows. But then when he comes out and declares it, like Tim Cook did a few years ago, then that's called coming out of the closet. Okay, so that's why the word closet indexing. So you're actually calling yourself an active manager, but in fact, inside the closet, you're behaving like a passive manager. You are just tracking the index. Okay, so closet indexing. So in closet indexing, active managers tend to closely mimic the weighting of stocks in the benchmark index portfolio, because basically the fear of underperforming, or they don't have ideas or whatever it is. So this phenomenon, this is basically what he's referring to here. Okay? That they don't have the guts to take a bold bet, a disproportionately large bet on IBM, as an example. So that's one point to learn from here. And the second is that what he's actually talking about here is that if you see what Graham is talking about is, he's, without putting it in those words, he's actually saying that diversification is not such a great idea. You should make concentrated bets. As I said, if you just go back 1 or 2 pages, you'll find the word concentration also in the text. And he's talking about concentrated bets, which means instead of having a nicely balanced fund which tracks the Nasdaq 100 index, you'll have a very concentrated set of bets. You bet that Nvidia is going to do well. Put like 15% in Nvidia. Then if you think Microsoft is going to win, put 25% in Microsoft, and so on and so forth. Okay, and that's how you should make bets. So instead of just having so many stocks, and you have a few stocks, and then you have concentrated bets in a few stocks. Now, this is another point that is very important to understand from a practical point of view, because if you read finance textbooks, or if you look at the ideas of theoretical finance in general, the academic ideas in theoretical finance, they will always promote diversification. But diversification, this is a conventional wisdom also. People will tell you, very often people will tell you that diversify, etc. But if you look at most of the very successful fund managers, okay, if you look at Buffett, you look at this guy called Jim Rogers, you can check him out, Jim Rogers. Then, so you can look at George Soros. Okay, Soros is a very, very successful investor. Okay, so you can read these 2 books. I would recommend you read these 2 books. Again, you can find most of it online. Okay, Market Wizards and New Market Wizards. New Market Wizards, and I think there's one more, which is, I think, Stock Market Wizards. So at least read the first 2, okay? The first 2 are by Jack Schwager. I don't know who the Stock Market Wizard book is by. Jack Schwager is the guy I've recommended another book from in your project resources, okay? On the futures markets, complete guide to the futures markets. So Jack Schwager did a couple of books, interviews with famous investors, very, very useful books to read, I think, for anybody who is interested in financial markets and the investing business. These 2, plus there is another book called Stock Market Wizards, if I'm not mistaken. So these are books, okay, books which are coming to mind. If you read these books, you will find that some of my book recommendations are are going to be peppered through this, just like my Peter Lynch book on One Up on Wall Street. That's also inside this note, and it's not formally inside the project resources, but these are books that are for further learning, okay, not necessarily directly related to the project, but further learning, okay, which you can. So if you read all these books, you'll do well. So make sure you read all these books which I'm recommending, and pretty much everything you can get online. So these two books. Now, if you read these books, you'll find that many of these very famous investors, Buffett, Rogers, George Soros, they do not favor diversification. They actually favor concentrated bets. Like Jim Rogers actually says that put all your money, we say in conventional wisdom, we say, don't put all your eggs in one basket. Okay? Actually, Jim Rogers has a quote where he says, put all your eggs in one basket and watch that basket very carefully. So Rogers is very famous for making concentrated bets. So this is one of the things that one of the kind of what should I say, non-obvious things, or something which is not not conventional thinking. If you just read academic finance books, you will think that diversification is a good idea. But once you understand how the industry operates and what the successful fund managers have done, because after all, you're going to go into industry, right? So you're not going to be a finance academic. So those guys, you'll notice that most of them they have a very poor view of diversification. So that's why I'm asking you to read these books, because actually, since you're going into industry, you should actually follow the people who have been successful in the industry, not people who go in for typical academic ideas like diversification. You should also read at this point. Another person who's not very big on diversification is Howard Marx. Howard Marx manages Oak Tree Investments. Okay. I don't know if she called Oak Tree Capital or Oak Tree Investment. Oak Tree is just search for that. Okay. So other than books, you should. So Howard Marx is actually also a value investor. So a fairly big fund, actually. Oak Tree is a very big fund. But the difference between Howard Marx and Buffett, this is important and interesting thing to remember, actually. See, Buffett is a value investor. That's why he thinks that this book is the best book on investing. Okay. Now, Buffett is a value investor. Now, Buffett operates in equities mainly. You look at Berkshire Hathaway, you'll see, even in Berkshire Hathaway, you will see, if you look at BRK, most of his holdings will be BRK. Let's look at A. His holdings. Okay. Anyway, it's not it's coming out clearly here. But anyway, if you look at the holding, basically we know this, that Buffett is an equity investor. Okay, so this is also something interesting to notice, that value investing is not something that applies only to equities. It can be applied even to debt. So this just briefly letting you know that Howard Marx is a guy who manages Oak Tree Capital or Oak Tree Investments. So he's also a value investor, but he operates in debt. He looks exclusively, and he doesn't invest in equity securities, whereas Buffett is a value investor who invests almost exclusively in equity securities. Sometimes he may make investments in preferred stock and things like that, which are kind of hybrids, but mainly Buffett is a equity investor. So value investing as a general principle, as a general investment philosophy, we usually discuss it in the context of equities, but it can also be applied to debt, and Howard Marx is an example of that. So when we are talking about famous investors and their actual real-life investing, real-life approaches to investing, we should discuss these people, and none of these guys are in favor of diversification. So in addition to these books, another thing I will tell you to read is very important. Please go and find it on the internet. Howard Marx Memos. Okay. So this guy writes memos. I think it's very useful for a new student. I mean, coming into the market, newly coming into the market, to read these memos to get an understanding of how to look at the market. Okay, so Howard Marks Memos. So read this also, and just do a search on on the internet for Howard Marks Memos. You will find the link. So he writes memos to his investors, but he makes them available to the public, and therefore a new student, it's very useful to learn from reading these memos. So that's one more thing. Okay, so as in terms of your further knowledge, and another person also who does not favor, since I'm on this topic, I'm just full name is Jeffrey, but I'm just writing Jeff. None of these guys favor diversification. Okay, all of them favor concentration. Now, Jeff Gundlach manages. Also, there is some very important learning from Jeff Gundlach's website. I'm trying to remember his. Okay, I remember now. So look at this. Okay, look up this website. He has a lot of discussion on bond markets. Very useful. Lots of learning for new students. Okay, it's called Double Line Capital. I don't know how they spell it. Double Line Capital is one of the very big bond fund managers. Okay, so Jeff Gundlach, and he does a lot of analytical work, and he makes it available to the public. So you can see lots of presentations on the markets, and very useful learning resource for new students. Okay, so these are all things that you have to do. These are not part of your syllabus. Okay, these are all things which I'm telling you because I won't have time with you for 2-3 courses. I won't have the luxury of spending 2-3 courses teaching you all this. So I'm giving you all these tips right now. These are all things that you have to take the ball and run with it. It doesn't necessarily apply to your IPM course, but if you want to be a serious candidate as a finance MBA student, you need to read all this stuff that I'm telling you here. Okay? And these are all ongoing things. This is one book. Okay, this is one book, but these are ongoing. This guy's analysis on the Double Line website, this is ongoing stuff because they keep on doing it and they keep on posting it. So this you have to do. This is your own this is for your own learning, continuous learning. Okay, so this is an important idea. On the back of that idea, we got various important distinctions, sources of. We discuss important sources of learning for students. So it's your job to follow it up. Okay? And what I will do here is, since I'm mentioning this, I think I should put it in the notes itself while we are discussing this topic and under perils of diversification. That to understand that, I'll just make a note of this. Okay? This point I made about Howard Marks and Buffett, I think it's an important point, and I think I should mention it here as part of the notes. Okay, that while value investing is usually discussed in the context of equities, I'm not going to write full sentences. Nothing sacrosanct about equities. VI, okay, so let's call this VI. So here the example is Buffett. Okay. So example Buffett, right? In the value investing as applied to equity. I think this is an important point for you to understand. That's why I'm making it into a special paragraph in the notes. It's very important for you to understand. This is what I mean by having a clear conceptual vision about within finance. Okay, so that value investing, normally we discuss with respect to equities, and the most famous example in equity is Buffett. But there's nothing sacrosanct about equities as far as value investing is concerned. What you have to understand what value investing is, it's just an application of a mean reversion philosophy, okay? And value investing is happening within the value investor is operating within the price versus fair value paradigm. What does that mean, price versus fair value paradigm? That means that you basically, if we go back to our example of the stock GE, okay, so you just do what is price versus fair value paradigm, which means that you look at any market and you first do, you look at the price, obviously, that's pretty easy to find out what the price is. But then you do you assume that the market is not semi-strong form efficient, okay? So you assume that the market is likely to be, mispricing or undervaluing or overvaluing the security, or mispricing the security relative to the fair value. So you do your fair value analysis, and your fair value analysis tells you that the fair value of GE is 300. So it's much lower than the price is much lower than the fair value. And in your philosophy, you assume that eventually price must move towards the fair value. And so there is going to be an upward movement like this. And so in order to profit, when there's an upward movement, your position has to be long. So that's why you buy it. So what I've just described just now with this example is the general aspect of the price versus fair value paradigm. So if you operate in this paradigm, the basic idea is always that you look at the market price and then you say, okay, fine, that's the market price. But that's not the end of the story. I need to find out what is the fair value of this asset. Here the asset is common stock of General Electric, but it could be anything else. So that's the basic idea in the price versus fair value paradigm, okay? So you're not satisfied to just look at the market price. Like a technical analyst doesn't care about fair value, okay? Because he thinks that everything is reflected in the price. The technical analyst doesn't care about it. So the fundamental analyst typically will care about it. So he will do an analysis of fair value and proceed as I described. So understand that when you're operating with a price versus fair value paradigm, okay, if this is the mindset that you subscribe to, okay, then value investing is just one application of this kind of mindset, and it basically becomes a mean reversion philosophy, okay? So which in most of the price versus fair value paradigm becomes mean reversion actually, okay? So therefore, there's nothing sacrosanct about equity. So what Howard Marks is actually doing is, what Howard Marks actually does, if you look at what his company, Oak Tree Capital, does, they are just looking at, let me see if we have any bonds. Can we track any bond prices? Apple has a lot of bonds outstanding now. We don't have bonds actually, but anyway, okay, so that we actually wanted to plot bond prices, but doesn't matter. So let's assume that these are actually, let's take another company and let's look at so what Howard Marks does is the same thing, except that he does it with respect to bonds, okay? So he will just do, so we don't really have bond, these are call options. So we don't have the bond prices here, okay? So they don't trade that actively, and they're not on an exchange. So that's why it's a problem. So let's assume that this is actually a bond price of Apple, okay? Let's just assume that. You can actually get it if you have a Bloomberg or something. So you can look at a particular bond of Apple, and they say this is the price, okay? So ignore this. This is actually the stock of ExxonMobil, but let's assume that this is the bond prices for Apple. So what is Howard Marks doing? He's doing exactly the same thing. He's going to look at the price and say, okay, this is like trading at 60%. It's trading at 60% of par value. Okay, it's trading 50%, and the par value is 100. So this bond is going to be redeemed at 100 unless there's a default. So then Howard Marks will look at this this kind of a bond price and say, okay, the fair value of this bond. He will do the analysis and do an assessment, just like you have here. He will go through what is he going to do. It's important to understand this, so let's spend some time on it. There's your bond prices. What is Howard Marks going to do? He's going to look at the coupon on the bond and say, okay, this is likely to pay this amount. Okay, um, and the if it's, let's say it's a 10-year bond, and the 10-year yield is YTM on 10-year bonds is, for this category of credit, is 5%. So he's going to take 5% as the interest rate and discount all the cash flows for the bond, and then he makes an assessment whether, I mean, if the coupon is 40%, maybe Apple will default and they won't pay 40, maybe they'll pay 30. So he has to factor all that into his analysis. Okay, but that's the kind of analysis he's going to do. He's going to make a projection about what cash flows are actually going to be realized on the bond and how much of the principal Apple will pay back. And he's just going to do this analysis. And this basically, the RHS is the fair value of the bond. Okay? The RHS, the fair value, this is the coupon on the bond, or whatever you think is going to be realized. If the coupon is 40, maybe the company will default. They won't pay 40, they'll pay 35. Okay, then you put 35 here. Whatever you think you can realize. And then you discount it using the market interest rate for that tenor. Okay? So it's like a 10-year bond, then you use a 10-year interest rate. So this is what Howard Marks does. Okay, he looks at any bond, they look at thousands of bonds, and they'll do this analysis, and they'll find out what is the fair value of the bond. And if they find that the fair value of the bond is 100, and the bond is trading at, so let's say the fair value is 92 or something, they feel 92 will be realized. Then, and the price is trading at 60% of the par value, but the fair value according to them is say 92 or something like that. Okay? In that case, what they do is they buy the bond again. Why are they buying it? Because they think that price will move towards fair value, and there will be an upward movement, and therefore by going long, they will make money on the position. So how is this any different from what a value investor in equities might be doing? It's no different. It's just that the asset class is different. Now, instead of being in equities, you're in bonds. Okay? But this is still value investing, because you are just applying the same philosophy, but you're applying it to debt. Okay? So actually, Howard Marks is a value investor, but he happens to operate in debt. You should know about these companies because these are very big players in these sectors. Okay, so this is what I wanted to mention here. That value investing is basically just an application of this philosophy, okay, using this paradigm. So you can actually do value investing even in debt. Although usually in the market, people talk about value investing from an equities point of view. Okay, this is something else that you should understand. Okay. So what is it that we need to write in the notes? So this can also be applied to this still value investing. Yeah. Can also be to write proper English, which is, let's say, it's harder to come out with fair value estimates for currencies and commodities, but technically, yes, we can write, and it can be applied in any asset class. Okay? But definitely, what you should know is that a typical value investing philosophy, as applied to equities, is also applied regularly to debt by investors like Howard Marks and Oak Tree Capital, and there are many other investors who do the same thing within debt itself. Okay, so these are actually many people who invest in distressed debt and all this kind of activities. So there again, the philosophy is always the same. Look at the market price, compare it to your assessment of fair value, and then take action accordingly. So this is important idea to understand that value investing is not just in equities, and also just taking off from the idea in the book that the idea of diversification is there in academic finance, but in practice, most of the star fund managers, they don't really like this idea of diversification. Even Mark Cuban, you might know Mark Cuban. Mark Cuban is the owner of the Dallas Mavericks. He started this company called Broadcom. Not Broadcom, Broadcast.com. Okay, so he's actually a kind of private equity investor now, and he owns the Dallas Mavericks. He owns, and he's one of those guys who appears on Shark Tank. You've seen that show. That's a kind of a venture capital kind of focused show. investing in new ventures. So even Mark Cuban is another one who actually believes that diversification is for foods and things like that. So that's another example I wanted to give you. So in real life, most successful investors don't practice this. A very important idea to understand, which is connected to the point mentioned in the book. Okay, now let's go on to. So this is a lesson from here. What are we going to? This is just general stuff. Mental and emotional attitude. That's why I told you to read The Disciplined Trader, the book by Mark Douglas. These are important things. Like if you see an intelligent investor here, what he says, who is an intelligent investor, not so much to do with IQ, but with really more about discipline. So this would be called a disciplined investor also. This book. Okay, so that's what he's saying again. Ordinary people, temperamentally well suited means taking the right kind of decision, being disciplined, rather than they can outperform the experts. What is he saying here? Measure or quantify, okay. How much? Yeah, obviously don't. What he's talking about is you should not overpay. But this is only a typically value investing approach, because if you look at like the other day I was showing you, now look at Google, look at Alphabet. The question of overpay. This is why Buffett got left behind in the technology boom. After all, it was quite a big boom, right? Now, it's always launching other stocks. I'll just come to this. But anyway, you can see this, right? Look at this. So when you say how much, in a way, you have to be careful about this, because how much, this is typically a value investing kind of approach. Now, that's not the only approach, because remember, value investing is a mean reversion approach. Okay, so value investing is a mean reversion approach. Now, this is not the only approach, as I taught you. What is the other type of investing philosophy that is the opposite of mean reversion? Anyone?
Momentum.
Whatever. Correct. Momentum investing. Right. Correct. You're right. Momentum investing. So momentum investing is, if you do mean reversion, that's what he's going to say, that this is not sacrosanct. Okay. So this is only applicable if you subscribe to this value investing philosophy, or the price versus fair value. Price versus fair value may be also consistent with momentum. That's a different, more complicated question we can come to. But momentum is certainly not consistent with mean reversion. These are totally different philosophies. Okay, and so these are diametrically opposed to each other. So therefore, this question of how much, you may actually make you can make money by even overpaying, what seems like overpaying for a stock. When you have a phenomenon like this, look at how this thing is going. Okay, it's just after this is the COVID crisis. Okay, and look at how it's going after the COVID crisis. So then if you say how much, if you put too much emphasis on this how much kind of idea, okay, you will find that you are being left out of major market moves. Now look at the kind of move this is, and there's no indication that it's over, because of course we can't click here, it will take us to something else if something happened here, but we can actually just reload the stock. Okay, so the point is that this how much, also you have to understand that whenever you read this book, many of the ideas that are presented in this book, you have to be able to identify that this idea only applies if you believe the price versus fair value, if you believe in mean reversion. The value investing is very much a mean reversion philosophy. If you believe in the momentum philosophy, you don't have to be so worried about this, because then you'll miss out on a lot of things. Okay, so that's the point I'm trying to make. So this is why the annotations that I'm providing are important, because we'll just look at Google once. So we'll just look at it. Hopefully this works now. If you look at even 1 year, yeah, look at how it's going in 1 year. And if you just look at how it's going in 1 year, just like this, okay? and it's just running away like this. This is a massive move actually. The stock has in fact more than doubled, right? So you will be left out if you focus too much on mean reversion. You will be left out of. You may be left out with this kind of big move. So while we have to learn value investing by studying this book, we should also have a broader idea in our head that this is not the end, be all and end all of investing. That there is another approach, which is the momentum approach, which helps you to get into growth stocks and stay inside growth stocks. Like in the case of Tesla, people like ARK Investments, like Kathy Wood that I mentioned. If you look at Tesla, even all time, people like Kathy Wood, they're still bullish on Tesla. Okay, they still think Tesla is going higher than this. So if you are a value investor, you will not be in Tesla right now because it's kind of very overvalued, you would say, using market terminology. But if you believe in growth investing, which is very much more aligned with momentum as an investing philosophy, then you will be comfortable being in Tesla. This is something important to understand, which takes you to a perspective which basically gives you a perspective which is broader than this just this book. Okay, so that's it. So again, I've taken 1.5 minutes, but then I was away for a few minutes, so that's okay. All right, okay. So the class is dismissed now, and the rest of you can go, and I will just take questions. Anybody who has questions, the rest of you can leave. Please watch your attendance timings. Okay, how much time you spend in the class, because ma'am had asked me for, she's asked everybody to report on the attendance situation. Yeah. Okay, anybody, any questions? No? Okay. I hope you're not falling asleep and just, I hope people are listening, because as I told you, this is not, I'm not making it interactive because that would really slow us down in terms of what we can cover. It's a lecture-driven kind of approach. But it's your responsibility to ask questions. The moment you don't understand what I'm saying, it's your responsibility to ask questions. Okay? So please remember that. And we're doing this. We are doing it this way so that I can maximize the amount of content that I can cover with you. So that you have to understand that. Okay? And as I said once again, I'm repeating that you do not have the right. If you're signed up to be a finance student, you don't have the right to get bored. You only have the right to ask endless questions. Okay, so remember that, please, because you're quite mature, no longer an undergrad. You have to take responsibility for your own outcomes. Okay. All right. So I'm going to stop sharing now, and then I'll stop the recording. Stop.